stock market's rigged. The United States stock market, the most iconic market in global capitalism, is rigged.
By whom?
By a combination of the stock exchanges, the big Wall Street banks, and high-frequency traders.
Who are the victims?
Everybody who has an investment in the stock market.
So let's talk about what Michael Lewis has actually exposed, why markets feel more chaotic today than ever, and more importantly, how disciplined investors can still win without trying to outsmart algorithms, institutions, or Wall Street. This has never been about fear, guys. It's always been about understanding the game that you're actually playing. Remember that famous Warren Buffett quote, "The stock market is a device for transferring wealth from the impatient to the patient." So guys, let's just say out loud what a lot of people are thinking right now. It feels rigged. It feels like every time regular investors start making money, something happens. The market drops 10%. Tech stocks fall 20% in a week. Some headline hits. And suddenly, your portfolio is red, while Wall Street somehow says they knew it was coming. You see hedge funds with supercomputers trading in milliseconds. You see politicians outperforming the market. And it creates this narrative in your head. The crash is manufactured. The system is built to transfer money from regular people to Wall Street and institutions. And when you start believing that, something dangerous happens. You either panic and sell, you sit in cash forever, or you start chasing really risky trades trying to beat the system. But here's the truth that most people don't want to hear. The market doesn't need to be rigged to take your money. It just needs you to react emotionally. And guys, I do not want you to be a victim. There's a process that works whether the market is rigged or not. I've been investing for over 25 years, through bubbles, through crashes, everything imaginable. I was around for 2000, 2008, COVID. And over long periods of time, I have done very well. And later in this video, I'm going to show you exactly what that process is. So let's assume, for the sake of argument, that the market is rigged, not in some dramatic sense of a bunch of guys sitting in a room going, let's screw Main Street America. Guys, it's not like this secret boardroom that exists where very few people decide how your portfolio rises and falls. You know how I know that? Go look at the returns of these Wall Street hedge funds and these banks when it comes to managing equities over a long period of time. Spoiler alert, they're shit. So when I say rigged, I mean it in a structural sense. Like you heard in the video, meaning the system favors speed. It favors scale. It favors institutions with better data, better technology, and better access. That part is not controversial. To some degree, that's just reality. High-frequency traders execute in microseconds. Algorithms scan headlines and react before you can even read the next tweet. Institutional desks can see order flow patterns that you didn't even know exist. So yes, if you're trying to trade short-term momentum, guess news, or react emotionally, you're probably playing a game where someone else has the advantage. And Munger always says, play the game in which you have the advantage. But here is the important distinction. The market may be rigged against speculators. It is not rigged against owners of great businesses bought at the right price. And that small difference changes everything. Because if you're not trying to win in milliseconds, if you're not trying to front run earnings or trade headlines, then you're not even playing the same game as the algorithms. You are playing the long game. And the long game still runs on fundamentals. And that's where we thrive. So before we go any further, let's talk about who Michael Lewis actually is, because this isn't some random voice shouting on social media, and many of you may not know of him. He's one of the most respected financial writers of all time. He wrote The Big Short, which is a complete story after the financial crisis of the few people who called the financial crisis. But you know what's interesting? Those few people were not major Wall Street banks. In fact, major Wall Street banks made fun of those people. He wrote Moneyball, which changed how people thought about data and competition in sports and in baseball. And he wrote the one we're most focused on today, Flash Boys, the book that shook Wall Street by revealing how high-frequency trading firms were exploiting tiny speed advantages to profit off of everyday investors. So to be clear, he's not someone who's anti-market. He is not anti-capitalism. He's against the idea of a structure that quietly disadvantages people who don't understand what's happening behind the curtain. When he said the market was rigged, he wasn't saying you can't make money. He was saying that the system rewards those who understand its mechanics and punishes those who don't. And that's where this conversation becomes important. Because the average investor, they're going to hear rigged and they're going to think, then what's the point? But a disciplined investor hears rigged and asks a better question. Which behavior is the system punishing and which behavior is it rewarding? So let's dive a little deeper into Flash Boys, because Michael Lewis didn't argue that the stock market was fake. He argued that it had become a race measured in these milliseconds with the goal of skimming small profits, but in such frequency that add up to big profits. High-frequency trading firms were building faster fiber optic cables between exchanges. They were placing their servers physically closer to stock exchanges to shave off microseconds. Why? Because if you can see an order before everyone else did, even a fraction of a second before, you can step in front of it and profit. Not millions per trade, pennies per trade. But when you do it millions and millions of times per day, pennies turn into billions over the course of a year. Now, here's the part that matters to you. This wasn't about stealing your portfolio returns. It was about skimming tiny amounts from short-term traders who were constantly buying and selling. The faster and more emotional the trader, the more vulnerable they were to this structure. And here's what's important in 2026. Markets are even more automated now. Algorithmic trading dominates daily volume. AI models scan earnings releases instantly. Machines respond to keywords, guidance changes, and macro headlines faster than any human could even think to do. If you're trying to trade by the minute, if you're reacting emotionally, if you're changing price, you are already competing against the machines and you're losing. I'm not saying that there's no world where it can be done if you have a strong process, but the odds are not in your favor. Now, if you're investing based on business fundamentals over many years, not just minutes, you're not even playing that game. F that game. That's where we need to talk about who actually gets hurt. The people who get hurt the most in a rigged market are blind buyers. They're the investors who buy because price is going up and they only follow price. They buy because someone on TV sounds confident. Guys, I personally know one of the guys on CNBC, and when I tell you I wouldn't give him my worst enemy's money to manage, I truly, truly mean that. They buy without asking one critical question. What is this business actually worth? When you buy based on price, you're not investing, you're hoping. And hope is exactly what gets punished in markets driven by speed, algorithms, and extreme expectations. Think about what we've seen over the last few years. AI stocks trading at enormous multiples, crypto surging on narrative alone, companies doubling on guidance headlines, and people buying because they feel like they're missing out. FOMO. That is emotional buying. And emotional buying is exactly what algorithms feast on. Because when expectations get too high, it only takes a small disappointment to trigger selling. And when that selling starts, machines accelerate it. Not because they're evil, but because they're programmed to react to momentum. The blind buyer buys high on excitement. The panic sells low when the trend reverses. That's not a conspiracy. That is human behavior that has been going on since the beginning of time. But what's interesting is behavior can be oddly predictable. So here's the part that most people don't fully appreciate. In 2026, over half of daily market volume is driven by algorithms, not humans. Algorithms don't feel fear. They don't feel excitement. They don't care about narratives. They respond to patterns. They respond to order flow. They respond to momentum shifts. They respond to volatility spikes. And when a stock starts falling, machines don't ask, is this company still good long-term? They ask, is the trend changing? That's why pullbacks today feel so sharp. That's why earnings reactions can be so violent. That's why a stock can drop 8 to 10% on what seems like minor news, go back to even, and then fall further. It's not because the world's ending, guys. It's because that large piece of trading has become non-emotional, and that ironically punishes emotional humans even more. If you buy because something is going up, machines will amplify that for a short period. If you panic when something starts falling, machines will accelerate that too. So your question should be, what does this mean for you? You need to recognize what's out of your hands. For example, you cannot control algorithms. You can't control the Fed or institutions, or if your stock rises or falls 10% any given day, month, or year. You can control one thing: the price you pay relative to what a business is worth. That's it. And fortunate for you, that's what really matters in long-term investing. Price is what the market shows you. Value is about the business and what it produces over time. Algorithms move price short-term. Fundamentals determine value long term. And over the long run, not days, not weeks, many years, even decades, value always wins. I guarantee you that if you buy a business that generates real cash flow, has a strong balance sheet, durable demand, and long-term growth, and most importantly, you buy it at a price that gives you an ample margin of safety, you don't have to worry about short-term games because you're not trying to flip it. You're trying to own it. The rigged part of the market punishes short-term reaction. It does not punish long-term ownership. When you're not constantly trading, there's not much to skim off the top. And this is where emotional detachment becomes your edge. If you're attached to the price you paid, or if you equate short-term movement with being right or wrong, you're gonna struggle, guys. Guys, look at other videos I've done where a stock I owned that was down skyrocketed. What do I say? Okay, it went up in the short run, but I don't know if it's gonna go up. This doesn't mean I'm right. I will be right 5, 10, 15 years from now when my thesis plays out. If you can separate price from value, if you can look at a business and say, the price is down, but the value hasn't changed and maybe even gotten better, now you're operating on a completely different level in the crowd. And guys, you're operating on a level that would crush Wall Street. So let me tell you something that changed my investing forever. The market doesn't care what price you paid. Those computers don't give an F what price you paid. It doesn't care that you bought at 150, now it's at 120. It doesn't care that you felt smart when it went to 170. It doesn't care about your entry point. It doesn't even know you own it. The only thing that matters is, what is the business worth today for you and what price can you pay? Most investors anchor themselves to this purchase price. That number becomes emotional. Guys, I'm guilty of it. Recently, one of the stocks I love, I thought it was grossly undervalued, has skyrocketed. At today's price, it still looks like a really good deal, but I'm apprehensive. Why? Because in some way, I'm attached to that purchase price I made a long time ago. That's just as bad as doing it the other way around. Guys, that number becomes emotional, it becomes an identity. If the stock falls below it, they feel wrong. If it goes above it, they feel right. That's ego. And ego costs you a lot of money. It's cost me a lot of money. Guys, here's a perfect example, and it's very recent. Meta fell from $340 per share down to $88 a few short years ago. People were not assessing the business. They were reacting to the price. They were saying things like Zuckerberg is done, he's to be removed, the company's finished, this is a falling knife, etc. That's what everyone else said. Guys, go look back at our videos about it. When I looked at it, I didn't see a price chart. I saw 3.5 billion people using the products every single month. I saw revenue was still growing. I saw massive free cash flow. I saw the fact, and I said this in videos, that in the US, Meta was making $42 or $43 in revenue per user. Internationally, they were at like $4. And I sat there and said, that's only gonna get a lot better. So I asked myself 3 simple questions that I always ask. Do I think this business will be around in 10, 20, 30 years? And my answer was an emphatic yes. Second question, will it have more revenue, more profit, more cash flow in that foreseeable future than it does today? My answer to that was yes. The third and most important question, could I pay a reasonable price for it today? Answer, absolutely. Guys, at some point it was trading at single-digit PE, but I want to remind you, I started buying it at around $200 a share and bought it all the way down. In fact, I actually got lucky and bought it on November 4th, 2022, which was the day it hit $88 a share. Guess what? All the way down, people were saying, see, you were wrong. I never felt wrong. I just sat there and said, okay, it might take some time. That same company delivered 20% year-over-year growth in 2025. Even back then, it was growing every single year. It's hard for people who are new to investing to understand that Meta was $88, not $600 or $700 where it trades today. The price collapsing didn't scare me. It attracted me. That's non-emotional buying. No guessing the bottom. No being brilliant. Just separating story from fundamentals. If you can do that, if you can detach yourself from the price and focus on value, you stop playing the emotional game the market that wants you to play. And that's when you stop being vulnerable to the short-term movements of stocks. Now, let's bring this all back to present-day reality. A stock I like right now that I mentioned earlier because it fits my process, Southwest Airlines. I was buying in the mid to high 20s, even in the low 30s. Even though the stock is up now over $52 following a big earnings jump, I actually think it still looks attractive, but I'm attached to that price before. That is the anchor that I have. But you have to be willing to pay up as value rises. You have to be willing to understand, hey, even though it's up 30, 40, 50, 60%, it could still be a good deal. Look at Meta. Meta at $88 a share was a screaming deal. It was still a screaming deal at $125 a share. Now, immediately some of you may be asking about my Southwest and go, airlines? That's risky. That's messy. Exactly. It's not flashy. It's not AI. It's not $1 trillion tech giant. It's a business that moves people from point A to point B. That's it. But guess what? Their profit margin has been 1.5% a year for the last 5 years. But before COVID, it was always 10 to 15%. That is my simple thesis. Too simple? Is there such a thing? The most simple thing you can do in the world is dollar cost average into low cost ETFs. And you will crush the hedge fund managers if you do that. Southwest was profitable 47 straight years before COVID. 47. That's not luck, especially for airlines. That's operational discipline. A simple fleet model, strong brand loyalty, and a cost structure that historically gave them an edge. Then COVID hit. The entire airline industry shut down. And even though travel demand has largely recovered, margins are not where they used to be. But I don't think that's because of anything other than just getting through some issues. Those operational challenges, those cost pressures, and investor frustration have kept the stock depressed. Now, this is where you have to ask yourself that key question. Is the business permanently broken, or is it temporarily under-earning? In my opinion, it's under-earning. And if that's the case, and you can buy it well below its intrinsic value, now you're stepping into the type of opportunity algorithms do not understand, because algorithms trade trends. They don't trade normalized future cash flow. They're not investing in the long-term turnaround play. And guys, I want to be very clear about something. I believe in day trading. I believe in momentum trading. I believe in computer algorithmic trading, but I separate those from investing. They're very, very different. Our entire process, the one that's followed by thousands of our community members day in and day out, is owning a business that you understand well at a price that makes sense and then waiting. Munger always says, money isn't made in the buying or selling, it's made in the waiting. And here's the biggest thing. When you operate that way, the market stops feeling rigged, because you're no longer playing the game it's trying to trap you in. So let me show you the exact process on Southwest. I'm gonna pull it up right here and you'll see exactly what I'm talking about. 10-year profit margin, 4.84, 5-year, 1.43. So just looking at this, in order for the 10-year profit margin to be 4.84 with the last 5 years of 4.83, that's a 3.5% difference. That means the last 10-year average, the first 5 years of the last 10 years was 8.2%. Okay? But if you go to their financial statements, if you go right here, income statement, let's go to a random year, 2018. They did $22 billion in revenue, $2.47 billion in profit. That is 11%. Okay, the year before that, 3.36 on 21 billion. That's 15%. It just went on and on. I thought to myself, why would Southwest have their profit margin fall 90% permanently? Didn't make sense to me. To me, I thought to myself, okay, they're going through those 737 issues. They went through their computer issues. These are all costing them money while their revenue just keeps going up. Record revenue. They do a smart way. They operate this very well. Guys, all these other metrics make sense in a lot of companies. For Southwest, it was purely this that I cared about, that profit margin. I sat there and said, this company lost money one time in a year. Over the last 50 some years, something tells me that's probably going to be a change. They're probably going to keep making more money. That's why I'm buying it. Now, am I 100% right on that? I don't know. For sure not 100%. But the point is, if I can buy 30 or 40 companies with the same kind of thought process, I'm probably going to do pretty well. Now, guys, I've gone through a lot of things. And if it feels overwhelming, guys, you're not alone. It's overwhelming for everyone at some point. The question you need to figure out is, are you willing to do the work to get better? Over time, I have come up with my principle-driven investing approach, and it's really important for me. And I have it here, I have it in my office. It's a way of me thinking about the world. It's a way of me thinking about investing. It doesn't matter whether it's real estate, because I have 1,000 apartments upstairs, or businesses, or stocks that I own. It's my way of thinking about things long-term, and it keeps me thinking long-term. Guys, I really want you to understand these 5 principles. The great news is I have an absolutely free PDF for you to download with those 5 principles with explanations attached. That way you can have it ready for you whenever you're feeling that tinge of emotion, which will happen. It still happens to me. Click the link below. We will give you that PDF absolutely free. Check it out. Now, guys, this is exactly why I teach on YouTube. You're not hearing this from anybody else on YouTube, anybody else of substance and channel size. Everybody talks about understanding investing. Guys, investing matters in one thing, the price you pay relative to the value you get. That's why I want you to have this principle-driven investing PDF. It'll help you stay grounded in that. Now, guys, in a few minutes, we're going to get to the stock analyzer, which is the price I would pay for this company. But let's look at analyst estimates first. Guys, look at this. Analysts expect $270 per share in profit, growing to $359, going to $430, going to $650. They're analysts, but let's just say they're right in 4 years, 3 years. So let's do a 20 PE on that $650. This is a $130 stock. Now, I don't know where it's going to go, but all I know is eventually, if this is correct, the stock will go much higher. What about revenue? Guys, 7.5, 5.5, 5.5, 7.5. I don't think this factors in a recession, because in a recession, people will stop traveling for luxury as much. But Southwest is not a luxury airline, so they might do well through that. Now it takes us right to our stock analyzer tool. This is where we put the story and the numbers together to come up with the price we want to pay today. Guys, I did a 10-year analysis. I look at this return on invested capital. An important metric to understanding, is this company good at allocating their capital, managing their money? 10-year number, 7.3, 1 year, 1.45, 5 year is negative, which means the first 5 years out of this 10 years, they were 15% return on capital. That is really, really high, really high. Revenue growth. I did 3, 5, and 7% for the next 10 years. You saw in the analyst estimates, they were 7 or 8% for the next 4 or 5 years. Profit margin. I did 8, 11, and 14%. Remember, this is all terrible, but I don't think this is the normal way. Free cash flow, I batched it. Now, 10 years from now, what PE would I assign to this company? Now, guys, the only reason I knocked it down a little bit is because it's an airline, because it has really good returns on capital when it's normal. I put 14, 17, and 20. Because the historical average is 15 to 16, but I should pay up for a good company, pay down for a bad one. I think this is a good company. I probably didn't put enough margin in here. In fact, I might actually go higher. I'm going to go 16, 19, and 22. 16, 19, 22. And finally, guys, for this video, I put a 9% return. This is no margin of safety. Just say, what is this company worth? What is the intrinsic value? The stock is currently at $54 on the nose. I hit the analyze button. If you're scared of losing money in the market, I know why. You've probably been guessing. And I used to do the exact same thing. I would buy stocks because someone on TV said that they're going to the moon. But that's not investing. That's rolling the dice. And that's exactly why I built Everything Money. First, it was built for me. I wanted the tools that gave me clarity and helped take the fear out of investing. People saw me using them on YouTube and said, Paul, how do I get that software? And I used to joke and say, you can't, it's a big data feed. But then it dawned on me, no, I can make this for other people. So I did. And a real community of people who agreed to grow together was born. Real people sharing ideas, live chats, live streams, and tools that help you be better than 99% of investors out there. I still use these tools every single day, like Stock Analyzer, Real Estate Calculator, and Retirement Calculator. So stop guessing, start learning, try it for $7 for 7 days, and see how your confidence will replace fear. Click the link on your screen or go to everythingmoney.com. Boom. Here's the prices. I have a low price of 66, high price of 195, middle price of 120. Guys, look at these potential returns. The way I look at this company is based on $54 a share. In my opinion, if I had 30 or 40 of these companies, I'm going to do very well because the chance of all of them doing poorly is very low. Every individual company, we don't know what's going to happen. What if something comes out and Southwest was lying about their numbers? I have no idea. But the point is, my goal is to apply this process to many different companies. So let's bring this all full circle. Is the stock market rigged? Guys, it's not even something you need to worry about. It is not rigged. You're just putting yourself at a disadvantage if you spend your time worrying about the pennies being shaved off your returns because of trading speed. Warren Buffett, every great investor of all time, started out as a normal human being. And in fact, if you go look at Warren Buffett's returns, they were greater as he was smaller. So when he was living in his house at 30 years old, 25 years old, in his attic, going through financial statements, that's when his returns were bigger. But now all of a sudden it's rigged? Makes no sense to me. Guys, I want you to focus on understanding real businesses and what they're inherently worth. Then buy them with a margin of safety. If you think they're worth 60, don't buy them at 60. Buy them at 40, 45, 30, whatever margin of safety you want. And finally, have the patience to let value play out over the years. Don't follow the stock price. Guys, I didn't know that Southwest was even at $54 a share. Sometimes I hear people commenting on Twitter and say, Paul, did you see blah, blah? I don't pay attention to my stock return, my stock prices at all. I sit there and say, I bought this great company. I want to see what it's worth 10 years from now. That's what matters to me. Guys, if you're willing to own Southwest or Disney long enough for a turnaround play to unfold, that could be years, 3, 4, 5, 7 years down the road. When you invest that way, though, it's not rigged against you. The market punishes emotion, impatience, and constant trading. You give yourself an advantage when you look long-term. It rewards that discipline. Michael Lewis exposed structural advantages. That doesn't mean the system is unwinnable. It means you need to understand the rules of the game that you're playing. Playing a game with less competition will give you an upper hand. And guess what? Nobody's buying 10 years down the road. You will be, though. And if you do that, you will win. And in 2026, with AI, with algorithms, volatility, and noise louder than ever, emotional discipline isn't just helpful, it's your edge. That's how you build real wealth. So guys, if you want to learn the exact process I use to determine the right stocks to buy and the price to pay for them, click on the video right here for the full course. Thank you for your time.